Today is April 19, 4:28 p.m. We saw unusual options today on Moderna, ticker symbol MRNA. And so we wanted to report that and also suggest a different trade idea than these unusual options we saw. So a quick overview, Moderna had dropped for the past 3 days. You'll see here and here and here on April 17. It had dropped close to 8% because of some news about their cancer vaccine. And so if you ever heard of the term or quote about waiting 3 days before buying, 3 red days, and or the other quote, don't catch a falling knife. Well, is this true? That we have hit a bottom now, because today it was green or basically flat. It was 0.13%, right? And so let's get right to these unusual options and see what was going on with these large institutions. So we have lots of these in the money options here. And the first one we see that is out the money is this 246. And you'll see 1,200 of these contracts. This is quite significant because if you were to sell that 145 put and then buy that 145 call, selling that 145 put is like saying you're willing to own 100 shares of Moderna at 145. So you need 14,500 per contract to put on that trade. And since there's 1,200 of them, that's a $17.4 million trade. And so this is definitely a large institution. And what are they telling us with this? Well, let's take a look. May 19 is all the way over here. At the 145s, you'll see here, volume here, much greater than the open interest. So we know this is an open order. And then also all the way here on the call side, volume again is greater than the open interest. So this is also an open order. So what they did was they bought the 145 calls and they sold the 145 puts. And when we analyze this trade, you'll see that at the current price of 142, if this goes up in price on the x-axis, this is going to be above the 0 line on the y-axis, which is the profit and loss. And so this is a bullish trade. It's a synthetic combo trade where you're basically leveraging the 100 deltas without having to buy 100 shares of stock. Because if you bought 100 shares, you would also get 100 delta. And so what they're doing is they're able to spend less to get the same amount of profit than buying 100 shares. And so that is the advantage of creating a synthetic, to get that leverage with options trading. Okay, and we'll see here our trade, because this is such a bullish trade. What we did instead was on the May 19th, we sold the 155s. You'll see here our position, and then what we did was for the next expiration cycle on May 26th, we bought the 150s. And so what that does, you'll see, is this creates a diagonal trade. And so here, let's analyze this trade. It also costs much less, $233, right? Their trade, as we said, requires 14,500 per contract because of the put that they're selling. Our trade here, if you take that off, this is what it is, a diagonal trade. and it is also bullish. As this 142 price goes up, it will be profitable. So you'll see that here. Let's check our Greeks. It's a near flat theta, so we like that. There's not much theta decay. Volatility is positive. We also like that because Moderna is actually, if we look at the volatility, it's pretty low. It's at 7%. So we believe the volatility has more of an upside to it. So we like a positive vega in this case when volatility is on the lower end. Okay, so again, this is our trade here, and this is their trade. Okay, so they definitely have a lot more deltas here, so they will gain a lot faster. But if you want that high delta, 100 deltas, you can always, for example, for this trade we put on, you would need 10 of them to get that 100 delta. So that's the catcher. You can kind of adjust your trade into smaller components based on the risk and reward and account size you have. Okay, so I hope this was helpful. If it was, please give us a like and we'll know to continue making videos, and subscribe and hit the bell icon, and you will be notified when we see these unusual options. Thank you and good luck and have a great day.